All right, we should be live here. Welcome to Thoughtful Money, everybody. I'm your Thoughtful Money founder and your host, Adam Taggart, welcoming you back here for something that's becoming a tradition here at Thoughtful Money, which is when the FOMC, Federal Reserve Open Market Committee, meets or gives their guidance, and then Fed Chair Jerome Powell goes out and gives his press conference. We then decode it for you here at Thoughtful Money with the help of Federal Reserve watcher and founder of the Merk family of funds and Merk Investments, Axel Merk. Axel, how are you doing today, buddy?
Great. But your audience missed all the prequel, that what happened behind the cameras before you went on the air. So that put me in a better mood than the FOMC conference. Yes.
Okay, good. All right, folks. Well, look, kind of a dull day, really not much going on. No, I'm certainly kidding. In fact, I mean, it wasn't the most exciting of updates to the Federal Reserve, the FOMC guidance. And Powell really, I think, did his best to I can't remember all the times he mentioned the word solid and strong and we feel good in his press conference, but the markets sure didn't like what they heard. And I think the S&P was down almost 3% by the end of the day, Axel, here. So a lot for us to unpack here for folks. Folks, I'm going to ask Axel a couple of questions to get the discussion flowing here. But then, as we like to do in these live reaction videos here, I want to take your hottest burning questions. So as you have them, please ask them in the live chat on the side. Somebody asked a question last time via Super Chat. So if you want your question boosted up to the top of the queue, feel free to use the Super Chat feature to do that. All right, Axel, well, look. You know, Federal Reserve, the FOMC, you know, their statement came out and very little changed. I mean, basically all they said was we're going to reduce our policy rate by another 0.25% or 25 basis points. And then they inserted a little bit of language that basically just said, and, you know, the timing of what we do from here is going to be, you know, basically fluid. It's, you know, we're going to be measured about how we determine how much we cut and the timing by which we cut. And that was really the big theme of the subsequent press conference with Jerome Powell, which was, oh, so you guys basically might not be cutting as much going forward. Then the Federal Reserve issued its dot plot, and lo and behold, the expected decrease in the Federal Reserve policy rate, the pace of that rate coming down, definitely is slowing based upon the estimations of the folks that sit on the FOMC. So, you know, I think that's kind of the big question now. And someone even asked Powell at one point, like, should we expect that this rate cut's the last one you're going to make going, you know, in this cycle? And Powell was very quick to walk that back and did his usual, hey, I'm not committing to anything. We're just going to let the data tell us what to do. And as I said, he tried to tap dance as best he could and say, guys, everybody's going exactly the way that we want it to. But certainly the market did not like what it heard. So what was your reaction to what you heard?
Yeah, not only did the market not like what it heard, it actually disagreed with the Fed chair. And I'll get into that in a moment. If one needed to kind of summarize as to why the market had such a fit, it's because Powell confirmed that we're in a new phase. CNBC, Steve Leisman, talked about, oh, you talked about calibration in the past. Are we in a new phase? And then he said, well, they don't know a new word yet, but yes, we are in a new phase. And the new phase is that rather than being kind of on a cutting mode per se, they're now feeling themselves out whether they should cut a little bit more. And that might not sound like much other than for data nerds, but it makes a big difference in the world, whether you're on a path where you go lower, 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 or we said, oh, maybe we're there where we want to be. And the so-called dot plots, and by the way, those projections used to be shrugged off as just opinions. Then they, a good year ago, I think it was, they started serving a good purpose, and Powell trumped them up, no pun intended here. And now it comes to bite him because they're a bit all over the place, these projections, but notably, those projections are suggesting that inflation is going to be higher. Indeed, there was one dissent here as well. And so it's why should they continue to cut? And Powell tried to put a brave face on it. He was asked by the Wall Street Journal Fed whisperer Nick Timiraos about what this all means, and Powell was struggling to answer the question, so the issue is that, as you may recall, having listened to anybody really covering the Fed insists they are quote unquote data dependent, and indeed the Federal Reserve has Powell very specifically has said that they are not going to be speculating. They're just going to look at the data. Except he had to admit very readily, when people make these projections, of course, they look at the political reality, because looking at the data would mean, and we talked about it last time, is that they would almost certainly be late, because they have to wait for the Trump policies to be implemented and to do action. Whereas, of course, the folks at the Fed are human beings and are anticipating that something might happen, and that's why they're pushing their own inflation estimates higher. And so whether we're going to get more cuts is up in the air, and these projections suggest we might get 2 cuts. Well, guess what? The market right now thinks we only get 1 cut next year, and so the market does not seem to be agreeing with the Powell Fed.
Well, so let me ask you this, Axel. So market obviously had a very extreme reaction to a slight change in the language of the FOMC statement, and is that because the actual change of, look, we are moderating our confidence in the timing of our rate cuts? Is that truly a really big deal, or were the markets just so overpriced that just a little, nudge in the wrong direction could create an outsized drop like this?
Well, I mean, context matters, and we, the media, anybody, right? We'd love to put meaning into things. Things are what they are. That's the plain answer, and of course, we like to give it meaning. The way I look at it, maybe it's a bit too technical. The second derivative changed. We used to have cuts, and now suddenly the pace of cutting will change. Possibly no cut at all. That's a new environment to be in, and if you move, or when you move to a new environment, it deserves a reassessment of the outlook. And by the way, the reason why these markets have a strong reaction, of course, there's part of it is what's priced in, right? Everything is expensive, so guess what? Maybe we'll start deflating some things. But the other part of it is the market is a discounting mechanism. And so if you're in a new phase, it's a new methodology, and the discounting works a little bit differently. And so now suddenly we're working on a plateau, or possibly a plateau, rather than ongoing rate cuts. It might mean that the new neutral rate is higher if inflation in the medium term is higher. That's all different, right? And so measures like the 10-year real yield, I know many in your audience hate it when I say that, because who knows what the hell the real yield will be in 10 years, meaning the net of inflation growth. That is the reason why changes in those metrics are relevant, is because risk assets, just about everything, is priced off those sort of things. And so when the perception is that the Fed is more hawkish in principle, it makes a difference. And guess what? Yes, that means overvalued or just expensive valuations might just be revalued a bit lower. There's a silver lining here, by the way. If one wants to see a bullish side, I can go into that.
Yeah, let's go there. But real quick, just before I forget it, I do want to put up the dot plots here, and folks, you can see here the comparison between the dot plots in December versus where they were just last month, and you can see that the median of the projections going out in 2025 and 2026 have shifted higher, meaning fewer rate cuts expected by the folks on the FOMC. All right, so Axel, and sorry, hold on one second. I'm trying to figure out how to turn this thing off. There we go. Okay, a few more questions for you, but you said, hey, there's a silver lining here. Where's the silver lining?
Exactly. Just before, for those who aren't quite as much data nerds as you or I are, the dot plots reflects the opinion about the folks that are being queried, which are the folks on the Open Market Committee. Not all of them are voting, and certainly all but one of the dots are not the dot of Chair Powell. It's his dot that's really the most relevant one of all those. So it just reflects the thinking. If anything, it shows that they're all human beings there at the Fed, and they're trying to digest the data as anybody else. The silver lining is that it's all priced in. So now we know we're in a new phase. We've reset it, and we can live happily ever after. What I mean with that is that we now have a new basis from which to go on. The Fed acknowledges that, okay, the series of rate cuts may be over. Maybe we get another one. And by the way, there's plenty of dovish stuff that the Powell had said. So if the market reaction were different, we might have a different conversation. Powell did say that that they don't want the market, the job market, to weaken further. He did say that they think that inflation will come down to 2% with the environment we have right now. We don't need to have rates quite as restrictive as they are right now. So he left himself plenty of room to continue to be more dovish. But that was not the message of the day that the market took away. And rightfully so. I mean, why on earth did the Fed cut rates when inflation is more persistent than it is? And when potentially the Trump policies might be inflationary. And then just to play a little bit of politics, right? We got this continuing resolution that's pending. Who knows whether it's going to get passed? I just saw a headline that that there might still be pushback, which means, of course, the Christmas may not come. But over 1,000 pages and gifts left and right, literally left and right. That's the reality. As much as we get excited about government efficiency, right? The reality is you've got to give out gifts to members of Congress to get things done. And so in that sort of environment, including extending tax cuts, including cutting regulation, that might boost growth, and that can also be inflationary. And so guess what? The folks at the Fed might be inclined to cut the rates less. And again, the end of the flip side is, okay, if we're not going to have a rate cut, the market says now we're going to have only one rate cut. The Federal Reserve says we're going to have 2 rate cuts. So now assume for a moment that the market is right. That means the next pivot of the Fed will need to be dovish. So if you want to be in the bullish camp, so to speak, it's all priced in.
All right. You just mentioned like 5 things that I want to talk about there. So where to start on this? So when you say it's all priced in, I mean, we've only had the price action since Powell's press conference, like what, a couple hours ago?
You mean a bear market can last longer than 2 minutes?
Yeah, exactly. So, I'm looking at a lot of the questions here, and some of them are saying, hey, like did today, here's one, today just did some real damage. People asking, does this mean the Santa Claus rally is over? As I said earlier, the markets have been trading very close to record highs. And if you look at things like the Buffett indicator, the euphoria meter, which is a real thing, we've been at all-time highs, or at least at data set highs, going back decades. So I guess one question for you, Axel, is do you really think it's all priced in at this point, or is there going to take some time to ripple the effect, for investors to run their numbers on this new phase that we're in and do the discounting that you were talking about earlier?
Well, I'll give you a few answers. The first one is forecasts are difficult, especially when they pertain to the future.
Thank you.
Yeah, thank you. Right. We obviously have asset prices that are very expensive, and the question is, how do you time a market top? How do you deal with that? And I think everybody's investment process is different. There's, of course, the market timer who thrives on the minute by minute or tick by tick action and thinks they can make a buck, and good for them. At the other extreme might be the Buffett approach, that when things get a little bit pricey, you start taking chips off the table and you might miss even potentially years of irrational exuberance. The way I look at it, as you know well, right? We focus on gold and gold mining. We manage about 1.6 billion in that, and part of the reason I talk about things being priced in is because, especially when it comes to the price of gold, because gold is such a simple asset in many ways, things are getting priced in very, very quickly. Now, if you go to more complicated things, like how do you value your wonderful high-tech company investing in AI, right? It takes a longer time, in my view, for the market to absorb things. And yes, new information is relevant, but there's always this expectation, oh, they're going to be just fine. There's a new technology that's going to be great. And then suddenly, at some point, more and more the glass is half empty. Take 2000, right? Irrational exuberant speech, then several years before what everybody talks about, the peak in the Nasdaq in March 2000, but I think the S&P didn't top out until September. And so forming a top can take a very, very long time. We do have also the unleashing of the animal spirits. Is it a short-term honeymoon that Trump is getting, or is it really unleashing of the animal spirits? And we'll know with hindsight. A lot of it depends on how things get managed and how messy things will get. Keep in mind, I mean, the U.S. is also not in isolation, right? In the U.S. now, we got Powell said he really likes the place the economy is. There's upside potential inflation. They'll be vigilant and so forth. In Europe, the economy is a mess. And Madame Lagarde, the head of the ECB, is trying to tell us that nothing to worry about on the inflation front. And so, and that's part of the reason why the euro is below 104 right now, including down today almost 1.5 cents, right? So we also, let's keep in mind, there's low liquidity in the markets. We are heading up into the holidays. We have what is called quadruple witching on Friday. The last several years, that hasn't been such a big deal anymore, but it used to be that on days when options expire and a few other things expire, that volatility will be exacerbated in the market. And so I wouldn't be surprised that one of these days, one of these expiration dates will be some fireworks. So that can always happen. I mean, the short of it is that you got to be comfortable with whatever asset allocation you have. And if you're just waiting for that one signal to run for the hills, well, good luck with that investment process. And by the way, if you do have that as an investment process, try to figure out when you want to get back into the market as well.
Yeah, we'll talk more about that near the end of this discussion, Axel. But on the point of, I think on people's mind is, hey, is this a turning point in the market, right? The markets have had great runs since end of 2022. Of late, they've been bunkers, animal spirits, a lot of Trump, enthusiasm. Obviously too early to tell, but interesting to see how quickly, they reacted negatively to the Fed's and Powell's comments today. One other thing I want to put in the puzzle here to ask you about is I was talking earlier about how stocks have risen to such high levels of valuation. But what's been interesting is since the Fed started cutting its policy rate, and it's now cut over 100 basis points, as Powell hammered multiple times today, the long bond yields have been going up, and they certainly went up again today after the Fed's rate cut today. So we're now in this environment where the Fed is cutting, so it's bringing down the short end of the curve, but the long end of the curve keeps going higher. How big of an issue for this? And again, as we talk about a market repricing, you mentioned discounting. I mean, assets are valued using a discount rate, at least through some methodologies of valuation, and the credit side of the discount rate just got more expensive, right? So that's mathematically going to have to start pulling valuations down, correct?
Yes. So first, a clarification. When I referred to animal spirits, I actually meant in the real economy. There is obviously some animal spirits in the markets when something like a fart coin, and I'm not making that up, is going through the roof. Then clearly there is some excitement. Let's just put it this way. But the animal spirits in the real economy, they do matter. That can create real economic growth. So I'm not being critical of it. And yes, the long there are many things that longer term rates signify, but they are a reflection, when not too manipulated by the Fed, of the long term growth potential. And we had rates move higher. We also had real yields move higher. So it's a when the Federal Reserve is more hawkish, the kind of one way to think about it is kind of the adding up rates over time of where they're going to be in the long run. So will certain projects not be profitable anymore at these higher rates? Sure. I mean, we've had too many projects that during the zero interest rate policy weren't profitable. And we continue, by the way, to have this bank bailout of banks that have utterly mismanaged their interest rate risk. But the Federal Reserve is also kind of patching up all these problems. So the Fed put is well in place. At the same time, yes, anybody who thought that mortgage rates are going to come down, good luck with that, right? So it's we have an economy where home sales are difficult. And so there are clearly some headwinds, and it doesn't take so much for the glass to suddenly be half empty if asset prices were to deflate again. And by the way, of course, we talk about the kind of the wealthy having lots of having the wealth effect mostly, but a lot of people these days have money in the 401k, not just the super wealthy. And those prices are, of course, also affected by what's happening in the stock market more broadly.
Yeah, which is, again, why I think it's such an important time to be watching this market here right now, because it seems like everybody is all in, right? We've seen, retail investors being basically record long. We've seen, seniors being record exposed to equities as a percent of their portfolios. And we've seen the rest of the world being record percent in the US market in terms of overall market cap, right? So kind of so goes the US stock market right now, kind of goes the world. All right, so I'm going to try to ask just two more questions and then start taking active questions from the live chat. You listen to Powell, and he kept saying, look, everything's fine, right? Inflation's a little sticky, but we're confident it's going to get down to our 2% rate. And we think, our policy is sufficiently, accommodative or whatever, that it's going to get, or tight, that eventually it's going to get inflation down to our 2% level. And we've got some math challenges that are keeping it a little bit artificially high, but we're going to get there, folks. Like, we're not worried. Labor market's cooling, but we're not worried. It still looks really healthy, right? So he keeps saying times are great, and our job is to try to keep them great, right? Hearing from a lot of people here in the comments, and certainly from some of the questions from some of the journalists who were there at the press conference, saying, hey, we're kind of worried about, Powell, you keep saying that inflation is going to keep going down and the economy is going to keep growing. I keep hearing more and more comments or worries about stagflation, where people are saying, I'm seeing more inflation challenges than you seem to be seeing, Powell, and I'm not sure the economy is going to keep growing the way that you say it's going to keep growing. So do you think stagflation is a probable outcome here, or do you think there are other outcomes?
Well, as you know very well, we had a stagflation ETF in the market. We pulled it again because running these things are expensive, and we didn't have enough traction to have it economically viable. But the reason we had put it up is because we thought that the stagflationary environment would not just be a short-term trade, but is like a 5 to 10 year type of risk. And it is in part because policymakers, when you're hit with a supply shock, tend to have the wrong reaction. The politically attractive thing is often the economically bad thing to do. And the other part of that equation is that on the monetary policy side, once you have a supply shock and once then you have high inflation, and because the Federal Reserve is late in reacting to it, things aren't linear anymore. And so you will have these bouts where inflation continues to move higher. And kind of the worst you can have is a mission accomplished speech like Lagarde has at the ECB. And so you gotta remain a little bit of caution. And that's somewhat what Powell is doing by signaling, hey, our neutral rate might be higher this time around than what you guys were thinking. And yes, it is possible, of course. I mean, we did have the unemployment rate move higher. We've never had the unemployment move higher as much as we had and then not have a recession soon thereafter. Difference is we had an election, if animal spirits and get released, and we have a Fed put everywhere. And we have less regulation. Of course, we can avoid a recession, right? It is possible, but it doesn't mean everybody will feel good, right? I mean, of course, I mean, if you look at consumer sentiment numbers, especially Republicans, when the Democrats in power, their consumer sentiment is horrible. The world is coming to an end, and come election day, everything is fantastic. Of course, the reality on the ground doesn't change so much, but perceptions matter. When people feel better, they'll spend more money, they'll invest more money. And so I wouldn't completely underestimate whether there is doom and gloom or whether there is optimism.
Okay. So Axel, we've spent a lot of time speaking in past reaction videos like this to your frustrations about how the Fed generally conducts policy, where you criticize them for not having a framework. And so they seem to be much more kind of just making it up as they go, and that bothers you, understandably. You also think the Fed talks way too much, that it really should just develop a framework, stick to its knitting, and talk only when absolutely necessary. How would you kind of grade what Powell did today?
An F. Jonathan Farrow, he's one of the anchors on Bloomberg. He had some great quotes today. One of them is that this Fed's looking a little bit lost, and it is because ultimately, right? I mean, it's a tough job to have. I mean, to just in their defense, and that's why they should probably give up the job and rather have some robots run it. The challenge they have is they have this debating club, and they're trying to do the right thing, and they're trying to communicate what their reaction function is. And the reason why that's relevant, and it's not just for data nerds, is that if you know where the benchmark of the risk-free rate is, of which all assets are priced, you provide a more stable environment, and that in itself fosters an environment where people can invest more or will invest, likely to invest more. And so when monetary policy is unpredictable, it creates suboptimal outcomes. That's a nice way of phrasing it, I suppose. And so Powell has been trying to convince us they're data dependent. And now we had an election that changes everything. And everybody knows that things are going to change. So what the hell are they to do? And so Powell had his foot in his mouth today by having to do a U-turn on many of the things they said. Well, is that on these projections, yeah, some people are data dependent, but some people are speculating and some people are making assumptions. All the things that Powell's preaching that they're not doing. And so that is part of the reason why we had volatility in the markets today. It's not just that we're in a new environment. And the way to fix this is to get rid of all this stuff. You have a rules-based Fed where you take out the discretion as much as you can. You can still take out the fire hose when there's a crisis, if that's what you want to do, but have a reaction function that is far more mathematical, not reliant on a debating club. And the outcomes are going to be, in my view, far, far better. Part of the reason I didn't start out complaining about this is because it doesn't really make a difference, right? I mean, what does make a difference when we're complaining? There's been a huge lost opportunity, right? The Fed completely messed up inflation, and yet they haven't even changed their framework. They still have their asinine backward-looking framework, and asinine is a CFA level 4 term for those CFAs out there, if you haven't heard it, making policy dependent on an average of what was in the past. It cannot possibly work. That's still the framework that's on the books, right? And they still say that, oh, we messed up inflation, but it wasn't really our fault. Everybody else also messed it up, and therefore everything is fine and we live happily ever after. That is just not acceptable. At the same time, it's a lost opportunity where you and I may complain, but they continue doing business as usual.
All right. So folks, I'm going to go to your questions here next. So to the extent you have questions, folks, ask them there in the live chat. I'll start pulling them in. Axel, before I pull the first one in, just a question piggybacking off of that last one. Okay, so you think the Fed is not operating the way that it should, doesn't have the framework, et cetera. You give Powell an F today, right? From all we can tell, Powell is going to finish out his tenure there as Fed chair, which will expire in 2026. Who would you like to see succeed him?
I would love to see Kevin Warsh, who has been in the news. The biggest thing working against him is that he has been in the news already quite extensively, so that's usually not a good omen. But one of the things that Kevin is a former Fed governor, and he's married to a billionaire. That helps in his administration, I suppose. He has talked about, one of the criticisms I've had is that after 2008, the Federal Reserve has taken away many of its gauges. And so that means the Federal Reserve is reading the tea leaves like anybody else. You can't look at the yield curve anymore properly and get a good feedback. You can't look at the overnight funding markets anymore to gauge the health of the banking system because you're applying an interest rate for everybody, all kinds of things. So he talked about using AI and other technologies before you and I on the air talked about AI, before it was in everybody's mouths. And the point being is that you got to look at alternative ways of measuring inflation, of measuring the health of an economy, to look at things. And he is also a big believer in a more stable outlook. In a more stable reaction function, right? To not just jolt things around as much. I'm sure if he were to be Fed chair, there's going to be plenty for me to criticize. But of all the folks that I've known running the Fed, he would be a breath of fresh air.
Okay. Well, it's from your lips to the universe's ears here. We'll see. All right. First question here, and these are in no specific order. This comes from S. Bain. Did gold fall today because of margin calls?
No, they'll come tomorrow. Okay. Of course, it's technically possible to get intraday margin calls, but it's actually the topic of margin calls. I think is an excellent topic because I mentioned earlier, it's all priced in. Well, what speaks against that is, okay, today the markets are down, a lot of levered players, and then we'll get a second wave when the margin calls happen. And so we could have a severe leg down in any market, right? I'm not saying that's going to be gold or equities or anywhere. Crypto, same idea, right? There's lots of levered crypto players, although a 5% move in Bitcoin as we had today is actually nothing too severe. Regarding the price of gold, the real yields jumped. The perception of if you have an expected higher rate path going forward, all else equal, translate to a lower price of gold. On the positive side, we are at a 450 10-year yield, and the price of gold, the spot price, is as we speak here, 25.85, so just under 2,600. So we're still at a very high price of gold relative to where we were at the beginning of the year and where we've historically been. So I would say the price of gold has stomached this actually very, very well. Does it mean we won't have a testing of this? Of course it's possible, right? And so yes, margin calls is something that will hit people usually with a delay.
Okay, so if to the extent margin calls are going to come into play in the near term here, they haven't hit yet, so maybe expect gold to still go down a bit further from there.
Well, and S&P and other things, right? I mean,
Right, and
anything.
everything, yeah, exactly. But specifically, this question here about gold and margin calls, probably still ahead of us here. So I want to note technically that gold did break below its 100 daily moving average today. So technically, that's also not super favorable for gold in the very short term. Let me ask you this, Axel, when it comes to gold, because I know people scratch their heads on this sometimes. So, okay, the Fed is signaling it might not lower rates as much, even though Powell's not saying it, but potentially because of inflation concerns. That's what everyone seems to think, right? So what usually wins out in the market's mind when that happens? Is it the Fed's concerned about inflation, and so it's going to bring down interest rates, so that's gold positive because real interest rates are going down? Or is it because, or is it that, hey, the Fed's pausing because it's concerned about interest rates, concerned about inflation, and hey, if it's concerned about inflation, that means that should be gold positive. Which one? So obviously, gold doesn't, go up in both scenarios, but you can make the argument in both scenarios. Why does it tend to go down more for cuts and not for inflation fears?
Well, I'll give you several different answers here. First of all, you mentioned 100-day moving average. The reason why technical analysis actually might be worth watching in gold is because gold doesn't have so many different fundamental drivers, and as such attracts many investors that invest based on technicals, and it becomes a self-fulfilling prophecy. I just like to note it continues to be substantially above the 200-day moving average. The second thing I'd like to point out, and mostly out of principle, is gold does not change. Gold hasn't changed versus yesterday. It's the price of gold, it's the perception of gold that changes. And there is also like relative what is priced in on the market positioning. So when a lot of people are buying gold, especially if it's on leverage, then of course, then a market reaction might be more pronounced on the downside. If anything, we've had a very extended rally for an extended period. The nominal price of gold is much higher. So in a day like today, when we have a $60 move, I actually don't think that's an extreme move. We've had in previous cycles moves that were $60, $90 when the price of gold were much, much lower. So on a percentage basis, by all means, it does give people a wake-up call. It's not like this is, it's 2 1/3%, right? So it is a move, but I do think one needs to put into context. I actually think price of gold has held up quite well. But the biggest competitor to gold is cash that retains its purchasing power. And so because gold doesn't pay a dividend, if you get compensated for holding cash, why would you hold gold? And relatives moves matter. So when Powell comes out and says, hey, I'm going to be tougher, that means rates are going to be higher, all else equal, and that might warrant a lower price of gold. And it's part of the reason I said earlier it's all priced in, because now we're in a situation where actually the Fed has to be dovish to just catch up or catch down with the market. And so that's just a noteworthy tidbit here. Obviously, as you point out, right, a few hours of move might not make all that much of a difference. Generally speaking, price of gold or currencies more broadly often react counterintuitively. So when an inflation print comes in higher than expected, the price of gold often moves down. And the reason the price of gold moves down is because the market immediately thinks, oh my God, that means the central bank is going to be tougher, and therefore gold should be valued lower because my cash is going to be worth more. It is then in the coming weeks and months where the reality kicks in and says, oh my God, well, maybe central bank isn't going to be quite as hawkish. And so similarly, I wouldn't necessarily overinterpret what's happening today in the markets. Now, clearly, I think the question whether this is a major turning point is a very, very valid one. But when it comes to something like, okay, I'm going to sell all my gold, well, keep in mind, as I pointed out, right, the continuing resolution that was supposed to be passed, who knows whether it will be passed, gives many billions in donations to the left and right. I hear, including some stadium in DC or whatever it is.
Yeah,
But
RFK Stadium.
importantly, nothing in the Trump book suggests we're going to have entitlement reform, which is really what we need to get these finances, the fiscal finances, in order.
Okay, and if we do have some time, I'm going to ask you a little bit more about the government situation, but more questions here. I talked a little bit about this earlier, but what does Axel think this means for bonds, right? So, okay, so we saw yields jump up today, which means bond prices go down. I'm going to guess the spirit of the question is Axel, given this new phase that Powell was talking about, do you expect that to have some sort of secular impact on the trajectory of bonds?
Well, bonds means many things to many people. And so the shorter you are on the yield curve, the easier it is. And one of the things is I like to keep it simple. Right? I'm a gold guy. It's how much simpler does it get? Interest rates are reasonably high. So why bother trying to figure out what's happening at the long end of the yield curve? You can lock in rates that are okay at the shorter end. Go it a little bit if you want to, but why take on all these additional risks that come further out? The 10-year yield is a pain in the butt to forecast, and I can give you lots of forecasts, and whether they're going to be correct or not is a completely different question. The big challenge is if you're thinking, okay, I like what this government is doing, but yes, there's a risk inflation is going to go higher. Yes, there's a risk that fiscal sustainability is not going to be there. So your reaction is, well, what the hell am I going to do about it? And you're going to say, I'm going to short the long yield because I think that the bond vigilantes are going to come out. Well, the problem with that is it is a negative carry trade. And so you got to have the timing right in order to make money on that trade. There's good money to be had if you get the timing right, but there is a lot of people that have lost a lot of money trying to bet against it. It's one of the reasons why people have diversified to gold, is because the cost of carrying gold is comparatively minimal. And of course, nobody knows what gold is going to do tomorrow, even next year. But over time, that's been a diversifier. That's been somewhat of a hedge against irresponsible government policy. The only thing I'd like to add, while I'm giving a little pitch for gold here, is that keep in mind when you own a bond, right? Keep in mind that the interests of government are not aligned with the interests of investors. And one more word, sorry for jumping around on bonds. We talk about government bonds. There's, of course, corporate bonds. There's junk bonds and whatnot. The spreads in the junk bond markets continue to be super tight. And what that means is that, and it's one of the reasons not to have a rate cut, by the way, which means financing conditions are lax. They're not as tough as the Fed would want you to believe. Now, clearly, mortgage rates are high, but financing is available. And so the headwinds to the economy are very light. And I think it's one of the reasons why the market suggests that we might at best get one rate cut next year, as of right now.
So, Axel, I came up with a list the other day. It was what is it? Economy growing at 3%, GDP, inflation, somewhat sticky, but has disinflated a lot from the 9% peak. We have unemployment, while it's gone up a little bit, still historically really low. We had, up until a few hours ago, animal spirits running amok on Wall Street, stocks near all-time highs, investor euphoria, at top levels. Some of the things that you just mentioned there, super loose financial conditions. And I think it's just, you go through that checklist and you're like, these are not conditions for cutting. Right? If anything, these are conditions where you're usually like, whoa, wait a minute, maybe we should think about pumping the brakes a little bit. And not, kind of get behind.
There is, of course, the philosophy, and some of the guests have discussed it, right? Should the Federal Reserve...
Let me just ask my big question. You can wrap it in your answer, which is, did Powell make a policy error by cutting too soon, or do you have a different opinion?
my view is the entire framework is bad. And
Right.
and
I
so
know you know that.
within that, exactly. So I'm not telling you anything you don't know. So within that framework, they told us they're going to cut. They cut. I mean, it's and apparently, based on the market reaction, it was a hawkish cut. Would have been a hawkish cut had they not cut, or had been a hawkish statement? Of course, it would have been, right? It would have been more hawkish. Would have they achieved more or less of the same? I don't know. I think there would have been plenty of reason to just
Yeah.
pause.
And I'm sorry, my bigger question was not just about today. It was starting this cutting cycle. Did Powell begin this cutting cycle too soon?
Same answer, right? It's the framework that sucks. Because Powell really started this October of last year, where he gave his first mission accomplished speech. I know several of your guests have said it was in December. I insist that if you listen carefully, he somewhat said mission accomplished already in October. And the reaction to that was it started to ease financing conditions. And by the way, you may recall that was the world where everybody and their dog, and yours truly as well, predicted a recession, or at the very least that we might be reaching the low in the cycle around election time. And within a few months, actually, I think we might have been at the low near that cycle. And so, yes, he eased conditions early. The challenge was really that you didn't have a metric whether inflation has been conquered. If you had a rules-based approach, if you had a formula that says based on some mix of inflation and unemployment, this is where rates are going to be. If you're wrong, well, then rates are moving up again. And you know the formula and everything is okay. Whereas if you have a discretion-based Fed, it is just such a high cost to the credibility if the Fed were to flip-flop. And that just makes it so damn difficult. So they start this new phase, and then they have all these wonderful debates, and they do it. And in the meantime, the market, of course, does what it does. I do want to get to this one point though that you talked about asset prices. There's this long-standing debate at the Fed: to what extent should the Federal Reserve control asset prices? Right? It started in the Greenspan years with irrational exuberance. Is it the Federal Reserve's job to worry about equity prices? And I think a good argument can be made that no, the Federal Reserve should not. The Federal Reserve should not worry about asset prices. But at the same time, of course, after 2008, they manipulate everything on asset price that's out there, and so everything but the S&P. And of course they know that low interest rates are going to kind of boost the stock market. And so now we're in a world where maybe rather not going down to zero, but we might have a low in the cycle of 3.5%, or wherever it might be, right? And so it's maybe we are already at a low point at over 4% in this cycle. It's possible.
All right. So speaking of asset prices, and I'm just going to ask you to do your best guesstimation here, Axel. You know, nobody knows the answers to this next question, but I mentioned all the reasons why there's a ton of froth, apparent froth in the equity markets. And even today's correction, doesn't take that much of the froth off. So I want to show you two user comments here. Brad here says, blow off top still ahead. Right? A lot of people think that we've been kind of in a melt up, in that last blow off top phase of an asset price bubble. And then we have Jack here saying, Powell's job is to create bubbles and then pop the bubble. Today, he popped the bubble. So which one of those do you think is closer to the truth?
Well, if you're not confused, you haven't been paying attention, right? Yep. And you can make a rational argument, not that it's their job to build a bubble. That's probably not Powell's job, but it is possible, right, that there is certainly a repricing that took place. That said, right, we had a decent decline in the S&P today, but again, nothing too dramatic. I'm unfortunately old enough that I've seen more dramatic moves in the market. We're just not used to those things anymore. But it's there's new information out. The market is pricing in the new information. The challenge, the reason why we don't know, is because you can argue this in many different directions. I mean, a cutting in regulation should boost growth. Obviously, there's a threat of tariffs, there's this and that, right? There's always going to be the unknown that's going to hit you. So having animal spirits unleashed can get markets really, really excited. That said, is this bull market tired? We've had, was it like a week or so of down days, advanced decline line? You talk about technicals deteriorating. So lots and lots of concerns. And are enough people ridiculing Warren Buffett? When that happens, then usually it's time for the markets to take a dive. I am personally thinking about investing as a risk management measure. And so I do think it is highly risky to be too exposed to the S&P 500. But can I talk people out of it? I don't think so. The one thing I like to kind of mention is what happens in an extended bull market. Let's assume you have a 60-40 allocation, 60% stocks, 40% bonds. When you have an extended bull market, that 60 portion tends to grow, which for many people, depending on their investment process, means that they're now overexposed to risk. And rather than doing what they should be doing is to rebalance, they get greedy. And on the tail end of that is what the tears are coming, because the time will come where they lose more than they're comfortable with. Now, you can argue, hey, we're still above where we were in the previous bull, when the bull market started, but that's not how human psychology works, right? And so you can have some really, really bad experiences. And so for most people, when the markets do well, the time to rebalance is when the times are good. I like it when the market is down because I'm thinking about what to buy, right? And the question I have is well, is it too early? And so I was saying, oh, maybe there's going to be another set of margin calls. Now, am I going to buy the S&P 500? Well, on the professional side, I'm not allowed to say what I'm going to do. On the personal side, I can tell you it's not going to be the S&P that I'll be buying.
Well, I doubt you'd buy the S&P at a CAPE ratio. If it was over 38 times, maybe it's 37 times today. It's still pretty rich. All right. Well, look, let me ask you this, investor psychology wise. JC says government shutdown is looming per Bloomberg. So yeah, today you alluded this earlier. We had the proposed continuing resolution had a bunch of pork in it. President-elect Trump has been very vocal on social media today, saying, "Hey, this thing should not go through." There's in real time public lobbying effort to get a bunch of Congress people to change their vote on this thing. Assume for a minute that it creates the conditions for a government shutdown here. Given sort of the shock that market participants just took today, if that doesn't reverse relatively quickly, would a government shutdown continue to make investors even more jittery, therefore making the market potentially even more vulnerable to at least short-term pessimism?
Well, in general, markets are discounting mechanism. A shutdown is really a non-issue for the markets. It starts to matter when there are some more serious issues on debt payments and whatnot. It's mostly drama. And keep in mind, the way that politicians deal with things they don't like is by showing outrage. And so we are outraged that, oh my God, how can they have this continuing resolution where they give money to everybody? Well, the reason they have it, I'm sorry for turning around here because I'm looking for a book. Here we go, I have it. There's a book I like to recommend to folks, The Triumph of Politics. And that was written in the late 80s. And this guy was a big part of the Reagan Revolution. And the subtitle is Why the Reagan Revolution Failed. And the reason why he says it failed is because he learned the hard way that in order to get anything done in Washington, guess what? You got to give a gift to everybody. And so this idea of government efficiency, it sounds great. We all love a good scandal about how a government agency is wasting money. But good luck actually changing the culture. Now, I'm not saying that if anybody can succeed, then the folks that are put in charge can succeed, and I think they might actually make a difference. But we see it on things like this continuing resolution, that's just how the sausage is being made. In order to get things done, you have a compromise. And maybe Trump is going to make a big fuss and this is all going to blow up and we're going to have a shutdown and everybody's going to be super unhappy. I mean, if you ask me what the best investment is for next year, it's in a bunch of popcorn that you sit back and enjoy the show. It is, but what does it mean at the end of the day, right? Will they succeed and not having all this garbage that gets allocated to everybody? Well, wouldn't that be great? But will that make an impact on the S&P 500? Probably not so much.
Okay.
So anyways, it is a mess. And I don't know whether we're going to have a shutdown. Usually politicians like to go home for Christmas and whatnot. And so who knows what's going to happen.
Okay, but you think it's relatively immaterial to the market action, whether or not the government
in the short term, unless this drags out for a long time.
Yeah. Okay. All right. Well, so in addition to rushing out to buy popcorn futures, how are you thinking about navigating 2025 ahead? And does today's new phase change in any way the thinking you had as of this morning about how you were going to tackle 2025?
I don't think there's been much of a change because the what we had today was to come sooner rather than later, and so the market is just getting used to this new phase. We continue to be an environment where inflation isn't fully beaten. We continue to be an environment where rates might be somewhat elevated. I don't expect them to go up for the roof. I don't expect them to go down to zero unless, of course, the proverbial shit hits the fan. Then it's, of course, going to happen in an instant. I do expect that there's a lot of good news priced in with the new administration coming in the markets. Governing is more difficult than talking. And at the same time, the deregulation is real. At least the ease of regulation. It's rare that regulations actually get kicked out. It's just the pace of increase of regulation gets slowed down. But that helps for people to invest. So I think that is real. I think the rest of the world will continue to be a big mess. I've continue to believe that what we see in Ukraine and Gaza is really just a symptom of the times we live in. Will there be disruptions because of terror threats? Yes, but we saw a lot of that in 2016, right? It's a negotiating tool, and that's part of the reason I'm talking about the popcorn. I like to have my long-term strategy. I'm on the record of having very significant gold and gold mining exposure. To just talk about the miner for a split second, what the value we see there is that they haven't participated as much in a rally as you would expect based on where the prices have come to. And the environment over the last 20 years that has not been favorable is kind of a below average interest rate environment with an above average inflation environment. And so a true financial repression type of environment. I don't see that we're heading into that. And so why I don't expect a smooth ride in any asset class, I'm quite comfortable how I'm positioned. And as you know, I do things outside of the public markets, from everything from forest and real estate as well, trying to keep debt levels low. And so I do some other things there as well.
All right, good. And you said earlier on too, just diversification will probably be your friend even more than not going forward.
Well, and the question is, of course, how to achieve that. Cash isn't a bad diversifier, right? I mean, it's just that if you sell stocks to get into cash, just do yourself a favor and think about when you might want to go back in, because most people never do.
Right. They stay out too long, then the market recovers, then they feel it's too overvalued, and the market.
Now that said, of course, most people's goal in life is not to beat the S&P 500, but maybe to have enough money to retire. They'll just be at ease with that. If you hold cash and the market goes up, You chose to be in cash, so be okay with that.
So you're making my point that I make on this channel all the time for me, Axel, which is exactly that, and that's why I think most people, if they haven't done so, should work under the guidance of a good professional financial advisor who helps them identify their goals, and then ask, okay, how much risk do I need to take on to hit my goals? Because you might not need to take that much. You might not have to be out there trying to beat the S&P every year. You could maybe do it with a lot more safety.
Yeah. And the question, I mean, one of the things though is most people don't know how to quantify that risk, because you can sit down with an advisor and have a number, but what the hell does that mean? And so what I tell people, can you sleep with that at night?
Right,
and of course, since I invest in gold, I don't mean the gold under the pillow, but are you comfortable? Are you comfortable? Like if you hold gold, are you comfortable with a $60 move down in the price of gold? Or is that too much for you? If it's too much, then maybe you're overinvested. Right? And the same applies, of course, to anything else.
Yeah. All right. Well, look, wise words. First off, folks, if you enjoy this format and want to show your appreciation for Axel too, for being so generous with his time so quickly after we get this read from the Fed, and you'd like to see these continue in the future after every Fed release and Jerome Powell press conference, at least after everyone that Axel is willing to continue doing this for, please let us know in the live chat. And if folks, like that, I always like to do more of what folks want us to do more of and do less of what folks want us to do less of. So let me know if you want more or less of this going forward. All right. And then Axel, again, thank you. For folks who would like to follow you and your work in between your appearances here on Thoughtful Money, where should they go?
Well, on Twitter, they can follow me at Axel Merk, or X, I guess it's called these days. I can't talk about any products on social media. Our corporate website is merkinvestments.com. And from there, you can sign up for a newsletter. You can look at what we do in the gold and gold mining space. Yep, engage. And I try to be responsive when people have questions, or come back on Thoughtful Money. If Adam has me again, then I can answer more of your questions.
Well, I think you can count that as a lock, given the very positive comments we're all of a sudden getting here in the live chat.
I like the excellent spelling. What is AXELLANT?
Oh, is that somebody said that? Yeah,
yes,
nice.
Exactly.
Nice play on your name. Well, very quick, folks, if you have enjoyed this, please do us a favor. Click the like button before you go, and then click on the subscribe button as well as that little bell icon right next to it. And if you would like some help from a good financial advisor for free, feel free to schedule one of the free consultations that we offer through Thoughtful Money. This is with the financial advisors that we endorse. These are the firms you see with me on this channel week after week. So to set up a free portfolio review, free consultation with them, just go to thoughtfulmoney.com. The URL's right there. And the form takes only a few seconds to fill out. Again, these consultations are totally free. There's no commitment, no strings attached. It's just a free public service these firms offer to help as many people as possible identify their goals, as Axel was saying, and then position as prudently as possible for what may lie ahead. All right. Well, look, Axel, as we wrap up here, I want to give you the chance to have the last word here. What parting bits of advice would you have to this audience, which, we do have a fair amount of professional investors that watch, but it's mostly regular retail investors that are just trying to be good, stewards of their wealth, and most importantly, not get, become collateral damage to, big market reversals. And I'm sure some folks are maybe a little bit jittery after today.
Well, have a process, but mostly invest in yourself. And that includes invest in your family, invest in your education, invest in your health. And the best way not to go broke is by spending less money than you make. That might sound like a very cheap and simple piece of advice, but most people have a problem on the spending side, not just the government.
All right, very well said. Wise words. All right, Axel. One of these times we'll leave a little bit more time when we have a boring update from the Fed, and maybe reserve the last 15 minutes to more of Axel Merk's thoughts on what true wealth is and how to invest in that, as well as just paper assets and the money
and
side of
how
things.
to raise your kids being financially responsible. That's something you might want to do one of these days as well. I'm sure there's going to be demand for that.
Absolutely. It's funny. You're the second expert this week to bring that up. Ted Oakley is just finishing writing a book on that, and we're going to do a special webinar early in 2025 around that, but I'd love to get your thoughts on that too as well. All right, Axel, can't thank you enough, my friend. Everybody else, thanks so much for watching.